Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. I wanted to talk you through the impending US inflation report. Of course, this is going to be one of the big movers in terms of markets. And so really, I wanted to give you a gauge of what's likely to come out and why we should discount certain things and how we should look at things in terms of what markets might do in reaction to this. First and foremost, as we can see here, according to Trading Economics, we're expecting to see the core reading move towards the downside. But crucially, the thing that's likely to grab the headlines is that the main headline number of CPI is expected to move either sideways or increase. Now, this would really rail against the idea that we're going to see a March rate cut and that we're going to see, 5, 6, 7 rate cuts over the course of next year. The fact of the matter is that the Federal Reserve are outlining 3 rate cuts over the course of this year, and therefore there's a disparity between the two sides that needs to be resolved. This inflation report might go some way to doing that because it might make people realize that we're unlikely to get back down to that 2% target anytime soon. Really, I don't think we're going to see it over the coming months, and therefore there's likely to be some pressure on markets once people realize that, and once the Federal Reserve really, in my mind, likely warn people that we may have to wait a little bit longer, or that we may see less rate cuts than have been expected. Let's break it down though. In terms of the big picture that we can see here, the headline inflation gauge, there's a number of different parts to this. First and foremost, we're currently at 3.1%. That 2% target, still some way away from where we are at the moment, considering people are expecting to see a rate cut in March. We're currently, of course, in January. But a key part of this really is the second section. As we see the month-on-month gains that we've seen over the course of the past year, I've got 14 months drawn on here. That December 2022 reading of 0.13 is going to drop out this time. And if we look at what happened last time around, the November reading was 0.097, so essentially 0.1. The reading that's dropping out was just over 0.1. So arguably, it does point towards a high likeliness that we're not necessarily going to move too far. So that does line up with the idea that we could see a flatlining inflation rate this time around. The key thing to take away from this month-on-month chart as well is the fact that if you look at the second and third number after this, we've got 2 big figures that are going to be dropping out next month and the month after. So 0.5 and 0.4 essentially dropping out when the January and February headline inflation readings are reported in the coming 2 months. That means that the main bulk of the disinflation move is likely to come in the next 2 months, not this one. So you could really start to write off some of the moves that we see today of the idea that actually, we weren't expecting to see the big disinflation this time around. We're likely to see it in the coming months. That being said, of course, it's worth bearing in mind that if you look ahead from that, April represents the only month that really has a chunky print yet to drop out. And the 2 big figures that are somewhere away are here in August and September. We've got the 0.63 and 0.4. So essentially between those 2 months, we've essentially got we've got 1% inflation. That's halfway of the target in 2 months alone. And we're going to have to wait a long time for that to drop out. If we analyze the move seen from the last 9 months and essentially see where are we going to be when markets are expecting the Federal Reserve to be cutting interest rates, well, annualizing that out, we've got 2.78, some way away from that 2% target. So we're going to have to deal with the fact that markets are preparing for a rate cut at a time when we're not at target, and it's a good chance we're still some way away from it. And that, of course, is a risk for market sentiment. In terms of the core reading, this is an area that's particularly interesting. We've got the CPI reading, which is around about 4%, and the PCE number, which is at 3.16%. I've put them on to, both of the lower sections of this chart as well. But one thing that I think is particularly notable here is that if you look at the PCE number, which is the orange line, we've seen lower prints over recent months. And that means that as we move throughout the year, there's a good chance that as we see these sort of lower prints feed into more recent months, there's a good chance that we see that core PCE number fall back down to target prior to the headline inflation, prior to the core CPI number. And so that PCE number, as this supposed, number one metric that the Federal Reserve like to look out for, it's going to become particularly interesting to see whether they are happy to just rely on that number or not. If you look at the 6-month annualized figure, we've got 1.87. So it means that over the past 6 months, we have been trending in a direction that is sub 2%. That is the kind of thing that could potentially point towards the Federal Reserve maybe saying, okay, we know that the headline number isn't where we want it to be, but we can explain that away because of things like energy and food prices that we don't have as much control over. And therefore, with the core PCE number below 2% or trending below 2%, then maybe they're going to feel more emboldened. But certainly, there's some big question marks ahead. Let me just show you, finally, things from a charting perspective. This is the S&P 500. We saw that pullback at the beginning of the month, but we're starting to push sharply higher. The move just below this 46.97 support level does point towards a risk that we fail to break through resistance and roll over once again. At the moment, that doesn't necessarily look like it's going to happen because we're seeing such strong momentum. But nonetheless, there's a good chance that we do see a break up through this resistance. If we do see a break through that 47.93 mark, then it looks like we could move onwards and upwards. Until that happens, if we stay below that level, any consolidation around about this area, this zone, does raise the possibility of markets selling off around about this inflation print. Because if we do see a move higher, people are going to start to realize there's a good chance that we don't necessarily see that March rate cut, or we see less rate cuts over the course of this year. Then looking at the dollar index, the daily time frame shows price action moving higher at the beginning of this year, consolidating a little bit since then. Really, we're looking at a sort of wider perspective here where we've seen the rebound, the pullback into the 76.4 Fibonacci and that bullish engulfing candlestick formation. That points towards a period of upside coming for the dollar index. But over the near term, we also have the fact that this shorter term downtrend still remains in play unless we break the 104.26 mark. The near term price action shows that we're largely consolidating. I think there's a good chance that we see inflation either flatten or higher. And whilst it is essentially expected by markets, if we do see that happen, there's a good chance that we see a bit of risk off sentiment coming into play. But the caveat here for anyone that looks deeper into the numbers, as we have seen, is that the disinflation is likely to come in the following 2 months, not so much this month. So keep an eye out for that inflation reading. If it comes in high, expect to see potential upside here for the US dollar and potential weakness for the likes of the S&P 500. But as we head into earnings season, there's a good chance that we see more of a focus on earnings and perhaps less focus on the Federal Reserve. But certainly for this week anyway, there's a good focus, or a big focus, on that inflation gauge. And I think there's a good chance that we do see some jitters as we see markets expecting it to move higher. And as the previous number is relatively low, and when it drops out, there is a good chance that we don't necessarily see a continuation of the disinflation trend that has underpinned expectations that we're going to see a big raft of rate cuts over the course of 2024.